All right. Well, hey, everybody. So excited to have Cam Cassidy with me. Cam has been a friend and a colleague for a number of years now. He's the branch manager at Right at Home Realty in the Durham region in Oshawa. A great office and a great agent. Cam was kind of like I think one of the trendsetters, in my opinion, as far as developing a niche market and servicing investor clients, and built out um, a tremendous business model around it. And Cam, so stoked to have you here. Thanks for being with us.
No, thanks for having me. And yeah, thanks for the kind words. It's always fun to chat about anything really, real estate related. I love it and could talk your ear off on really any topic. So, no, happy to be here and thanks for having me on.
Yeah, awesome. So, yeah, and I always enjoy my conversations with you around real estate because of your wealth of knowledge and you're actually paying attention. It's one thing to know how to like ride waves. It's another thing to understand the fundamentals of the waves and to like
Good way to
you
put it.
really dig in and don't just go with the flow. You really dig in and analyze and make wise decisions in your with your own real estate portfolios and with your clients. And Cam's a great real estate agent.
Yeah, I feel like anytime we get on the phone, it ends up being a long conversation. We get into a number of different topics. And I know we were talking last week. You're like, we should just put this on video. We should talk about this. This is good stuff. So,
Yeah,
uh,
we just started flying, and I was like, "This is like so useful." I think
I
what's
told you I could talk your ear off.
yeah, yeah, and what's fun, it was kind of a while. I think was it like 2020 or 2021? I forget, somewhere around there. You were like, "Hey, I got this real estate that I want to put a line of credit on," uh,
hmm
and so we put together a product. The line of credit, home equity line of credit, was this one we did through Manulife. And you really like have taken that and used it for all that the product is intended for. And so I thought it would be useful for just anybody considering the kind of the dormant equity in your home, because sometimes we have various assets that we're willing to liquidate and move around, and the home is harder to move around, but there's like money that grows there that
Yeah.
you can put to work for you, and you've like really leveraged that. So like, what are some ways that you have maximized your home equity line of credit?
Yeah, and then this is kind of what got us into this conversation was, me sharing some of the things that I was doing with it. But yeah, I mean, I didn't realize how great of a product was at the time, even when we got into it. It was just like, it's our primary residence and we have, no mortgage on it. So we are able to put this line of credit on it. And at the time, like, we kind of just said, okay, let's do an appraisal. You can get up to 65% loan to value. I said, great. We got access to funds, and it kind of just sat there for a while. And then the first thing I did with it is I bought an entire property in Florida with it.
Yeah.
So I found a property. There was like a really good deal that came up. As you know, like I originally had bought the condo through, we financed it through you and had that. And then another project came up that was from a wholesaler, so really quick moving and kind of needed to jump, right? And this is the benefit of the line of credit is you have access to capital instantly, right? Instantly, and you know the rate, the calculation. It's very easy as an investor to run numbers with, because of the way they calculate the interest. You can do interest only payments, so you can kind of decide what principal or interest payment you want to make. Just unbelievable flexibility for that kind of thing. And so I literally bought an entire house from Florida in Florida duplex where we renovated it, we got the tenants out, and then ended up selling it a year later, paid off the line of credit, and kept the profit, paid the taxes, of course, and then yeah, so that was the very first thing I did with the line of credit.
Yeah, and because of the market, you ended up moving that one a little faster than you anticipated, I remember. But you also were able to like then take that investment and put a line of credit on that too, weren't you?
hmm
Was that part of the plan? Like you were able to liquidate, move, and like be moving stuff around, like just continue to build.
Yeah, well, that was kind of the original plan. It was like, I used the line of credit initially for the speed, right? The closing was in 2 weeks. It was, you couldn't finance it with an A lender. You couldn't do anything like that. It was just too quick of a turnaround. So that's why I put it on the line of credit or I use the line of credit funds. And then, yeah, so then I was kind of exploring options and then I opened a line of credit, another line of credit on that was secured against that property and the rates were just getting too high. Like I think that rate ended up being like 9%, 10%. It was like fluctuating variable, whatever you want to call it from the American standpoint. Because then I'm like, great, I could go acquire another property, and and that at that point, my mindset was, to build, right? To continue to grow and keep adding these cash flow properties. But then quickly realize, you know what, interest rates are going up. I'm 100% leveraged. Like I had none of my own money into the property, right? It was solely my line of credit. So I was 100% financed, which is super risky, right? Which is super
Yeah.
risky for anybody,
Yeah.
kind of watching this. I don't recommend it. And that's where I kind of said, you know what? I had about 90K worth of profit, I figured, based off of getting the tenants out, based off of doing the light rental that we did. So I said, I'd rather take that and run. And then I cleared up my line of credit. I closed that other line of credit. It kind of like, was a safer play, right? To take
Yeah.
the money and then I had access to that line of credit again, which was great, right? So if I wanted to deploy it or use it for anything, I could. And I think the beauty of the product, what I didn't realize is I don't even know how to describe it because I also have a home trust line of credit, home trust capital. Am I saying that right?
Yes.
Uh,
Home trust. Home
Home
trust.
trust,
Yeah.
yeah, on a
Yeah.
different property. And so it's interesting comparing the two products where that one, like the technology to go on and like see my balance, is very tricky and very outdated. Where the Manulife one, you could pay bills off it. You could set it up to pay bills. You can do automatic transfers from it. You
Yeah.
can, like I even, my paychecks I'll get directed right into the account. So it acts like a bank account as well as a line of credit, and you could treat it like a bank account, which there is other deeper benefits to that where you can, kind of front load the money and then they'll even pay you an interest rate if you have a positive balance. So things like that are awesome and useful. And then recently, what we've been doing is kind of waiting for the next flip, the next play, and taking small amounts. And this is what kind of piqued your interest was we know the interest rate, right? The current interest rate is 5.45%. Very reasonable, very low for a home equity line of credit. And we will take that like a small portion and buy like an ETF, buy a dividend paying stock, and the one that we purchased is around 12% interest that it pays. So this is an arbitrage, kind of a carry trade, people call it, where you're getting the spread, you're collecting the spread, so you're making 12%, you're paying 5% in interest, 5.45% in interest, and then collecting the profit. And again, you're taking the funds to invest in something that pays you monthly. And of course, that dividend gets taxed as income, but you can write off the interest of the line of credit if you're using it for business expense, if you're using it for an investment purpose that generates income. So it's kind of a good short-term way to utilize some money. We're not going crazy with the amounts. We're certainly not using, a lot of the line of credit. We're still keeping it like a lot of it available for things that come up. Like I'm really more interested in flipping with it and doing things like that. But it's great to kind of find that, utilize that spread, right? If someone's going to lend you at 5% and pay you a higher return, I would argue that's all real estate investing. That's all what
Yeah.
mortgage brokers are looking at, and investors. They're saying, how much do I, have to pay? What are my expenses? What are my income? Is it worth me taking that risk to buy that spread and buy that product and take that risk, so to speak? So yeah, that's what we've been doing with it recently. And I remember last week we were talking. I kind of said, Dave, I don't know if you are pitching this to other clients, but this thing's a great product. Like this thing is unbelievable. And you were like, I know. I'm trying to I'm
Yeah.
trying to convince people.
It's a great tool. Like, well, when you said it, I was like, I'm not making this available enough to my clients. I'm not really a hard sell kind of guy anyway, but I was like, gosh, this is really good. It was the best product that we put you in at the time as far as what you qualify for and what we could access for you. Their product was the best. And then to hear you talk about it, I was like, oh, this is really great. And there's a couple of things I want to pull out of what you just said, because some people like it can kind of blur together when you start to think,
For
oh,
sure.
banking, paying down the mortgage faster, making money. There's a number of different concepts
Yep.
and quick equity plays on flipping. And a quick note, like if you see Cam flipping, you can flip. If you don't see Cam flipping, don't flip. That's my rule. When I see you start to buy, I'm like, okay, it's safe to flip. That's a side note. But one of the things you said there is you can pay down your mortgage faster. And this is a great feature of line of credit products where you can
Mhm.
accelerate your mortgage payment because you can actually have your paycheck deposited against your mortgage, and the daily interest calculates and saves you money over the long haul. Have you found that to be the case and useful for you?
Yeah, because they calculate the interest daily, it just benefits you to put your funds directly into the account and then pull funds out when you need it. And then so yeah, like if we want to invest with something using leverage, but then we could choose to pay it down quicker, pay less interest anyway, by simply just putting the money directly instead of having it sit in your regular checking account, which is doing nothing. You might as well pay it off onto something that you're paying interest on, right? So, we're not really like if I'm making X amount of money, it goes into that account, and then I'll transfer it out to my personal account, and all it's doing is reducing that interest amount temporarily. But they're calculating it daily for the daily
Yeah.
amount when they bill you monthly. So why not take advantage of that and pay a little bit less interest and yeah, and utilize that.
Yeah, absolutely. And then the investing, you're actually investing in through. I mean, we won't endorse specific companies, but like you're investing through.
Directly. It's like
So little. Oh,
it's like direct investing. Yeah.
direct investing. Okay, yeah,
Every bank, every lender has like direct. You can open like a direct investing account, where basically you're getting control. You're able to buy ETF stocks, whatever you want. You're not going through an advisor, although you could go through an advisor. I have thought about that. It's not. I know. I actually spoke to. This is kind of what gave me the idea, to be honest. I was speaking to a financial planner, and he's the one who kind of suggested it. He was like, "Well, why don't you borrow money from this and we put you into something?" And I went, yeah, I never really thought about that. I always just was kind of waiting for the next flip or waiting for the next opportunity. And he's like, yeah, like you can, things, you find something, you can sell the stock. You put in X, you invested, borrowed X to invest in Y. Hopefully it's keeping the market hasn't dropped crazy amount where you're losing a lot. That's the only risk where then you can't, you may be limited unless you want to take the loss, right? If you're down
yeah,
or vice versa. If you're up, you're paying capital gains on it, on that the investment as well as the income. But no, I mean, and I don't know. I'm stubborn, as you probably know. Like I like to do things myself. I like to have the control.
yeah,
But there's ETFs out there that pay a monthly dividend. Some can pay weekly. It's not always quarterly. So literally, we have our interest payment that comes out. We'll take the portion that pays off the interest. We'll transfer it to the account. That interest is paid off. We're back at zero. And then any additional profit we get to either reinvest, we can pay down debt, or we can use our income, like any sort of income that you have. You always have that option. You just have to remember you're paying taxes on that income. So, it's,
right.
you still have to be prudent yourself to make sure, like with any tax planning, that you're keeping capital for that. The government always takes their share.
That they do. That they do. So, so you can pay it down faster. Then you mentioned as well that the when you borrow and to do business with this money or to invest with this money, um, the interest that you pay, you can write off. So you have this interest that you can write off, and then essentially, like, where else can you get access to 100 grand, 200 grand, 300 grand, whatever your HELOC is? And it's tax-free money that you're doing business with. Like all the other investments that we're out there doing with our after-tax money. Like here's like money that's sitting there dormant that you can
Yeah.
pull out and put to work. Obviously, you don't want to be reckless, and I have heard stories of people getting into the stock market or getting into real estate deals, and you lose money. You want to move conservatively with advice, not hastily, and that's one of the things I admire about you is that you really take your time to know stuff before you start, getting
Yeah, and I
it.
mean, people, when you have that line of credit, of course you can abuse it. You can buy a boat, you can buy a truck, you can buy things that are liabilities, and that, you're really now just behind, and you still have to owe that money. But to me, borrowing money to invest in assets is the key.
Yeah,
And to your point, like buying a stock, and this is a bit an important point, buying a stock that doesn't pay a dividend, like Tesla or one of these, high profile stocks. They don't pay a dividend. They're very volatile. I would definitely not recommend borrowing against that to buy a stock. That is insane to me.
yeah,
That's why I like to emphasize, like, I'm in it not for the appreciation. I'm in it for the spread. I'm in
Yeah.
it for the 5%, 6% return, to kind of build wealth slowly, to get money working for me, that type of thing. Not necessarily for things to go up like crazy. Obviously, don't want them to crash, but I'm not speculating, right? I mean, to me,
Right.
it's the same
Yeah.
as like buying a pre-construction condo, right? I've always been against it. I've always said don't do it. Now I'm looking like a genius, but it's the same with stocks, right? Like to me,
Yeah.
buying a stock that isn't dividend paying, is somewhat speculative in that the company's going to perform, the growth is going to be there. And there's way smarter people that are analyzing these things that
Right.
know about this stuff. And that's where if you want to do that stuff, you should use a financial planner. To me, where I'm doing broad-based ETFs that
Yeah.
paid income, like Nasdaq, SPY, which is the S&P 500.
Yeah.
There's ETFs that cover like a wide range, but also produce income,
Yeah.
instead of going up. And yeah, so I mean, there is the other side of it where people don't like dividend paying stocks and things like that. But I mean, that's, you could you could have a side to every conversation. But
Yeah. In the long run, like if you're playing for like the 30-year game, dividends should be reinvested. But if you're talking about like the short term, actually engaging the capital and keeping it cycling, like is that not, are you like it's a different story, like as far as buying dividends, it's a little bit of a shorter play. Well, like explain like just what dividends are, like from your perspective. I mean, what from your
yeah.
knowledge currently.
Yeah, it's just a monthly, quarterly, annual payment that is coming out of the company's capital. So yeah, I mean, a lot of people don't like high-paying dividends because they feel like they're like, well, hey, the company's just hurting themselves by paying you the cash right now. They would prefer lower-paying dividend stocks, 1, 2, 3% type of stocks where their growth has a higher potential, or even stocks. That's why stocks that don't pay a dividend are like growth companies, right? Nvidia, Tesla. They're saying, no, we're using all our capital to reinvest into the business, to grow revenue, to grow profits. We're dividend paying stocks. It's hard to grow. The upside is capped almost because of the amount of dividends that they're paying. And I mean, I would argue it's no different than like a pre-construction investment versus like a cash flowing Airbnb or a cash flowing multifamily. Um, you know, my belief is though, like once you have that capital, you can either pay down the debt slowly, right? Which is, if you borrow, let's say $100,000 in stock, you have this ETF that pays you, let's say 12%, 1% per month. You can pay down that. So if you're 100,000 in stock on day one, and then you're slowly working that debt down, because it is a risky play to borrow, right? It's called margin, like you're buying on margin. And a lot of people would, have to be cautious. You're borrowing to invest, which is always risky, and you really have no money of your own money in it, right? So you're 100% leveraged, and I think the key with the line of credit though is your rates are a lot better, right? Because it's a home equity line of credit, you're not going to get margin called. It's secured against a property. It's secured against real estate. They're not coming to knock on your door to say, "Hey, how are your stocks doing?" They're not. They're saying, "Are you paying your interest?" They're not. Where margin investing and margin accounts will do that, right? So you have a little bit safer play there, in my opinion. But yeah, going back to your original question, that dividend is a monthly income, right? If you're doing it correctly, and so you're doing the math on here's how much the stock is worth, here's how much they pay, and those dividends will fluctuate, but it is income that you can use as cash. They'll pay it to you in cash. You have it sitting in your account. You can buy more stock. You can pay off your debt, or you can go shopping with it. You choose whatever you want to
Right,
do with
right.
it. But it is cash they're paying you monthly, quarterly, weekly, however it's set up.
Yeah, so like just simple numbers on that. Like if we were to use 12% as our number, and I think 545 is probably about what you're paying right now on the HELOC. So if we did 100,000, that's literally $1,000 a month coming in of income, $454 paid to interest. So you're
Yep.
you're there's 500 and change. Like I can think of a number of people that would make a difference. For my
Yeah.
family, that would cover half a week's groceries, but
Out of
but
thin air, right? And this is creating money out of thin air, right? Like you're
yeah.
making $500 a month on that profit, and yeah, again, I would be cautious spending that money.
Yeah, yeah, yeah,
To me, like option one would be pay down the debt. My number I've always played with is 65% loan to value. That's where I try to keep my loan to value ratios on all my properties and any of my investments. To me, that is where you're maximizing your return on equity. So, you have money that's sitting there, you're losing that opportunity cost, right? So, but if you're 100% leverage, that's risky. You're going, oh shoot, like lots of things can go wrong. So my
yeah,
focus would be to pay down your debt to 65%. So your now line of credit 65% or 65,000, but you have 100K worth of stocks. You're in a good position. Now you can start, at that point,
yeah,
reinvesting and buying more stocks, or you can now say, you
yeah.
know what, I'm comfortable to actually take that money and go to the movies or go grocery shopping or go spend
Right,
it
right.
kind of freely once you're in a safer loan to value ratio.
Yeah. So you right now you focus on you say buy $100,000 of stocks, all the investment goes to just returning that money to the line of credit. So essentially putting it right back in your pocket as far as liquidity, but also essentially paying down, and the value is being created by the stock that's paying the dividend. It's
Yeah.
genius. Yeah. So
Yeah.
it's, yeah.
And then so a lot of people will say, like, what about the tax consequences of that? So, similar to me putting my paycheck right into the home equity account, I will put the dividend directly on the line of credit to lower the interest rate. But I know, like, when I get the tax bill, I'm going to have to pull from the line of credit. I'm going to have to go up. So if I get down to 65,000, I may need 10,000 to pay for my tax bill. But similar to what I was saying, instead of just keeping it in cash, why not just pay down so your interest rate is overall lower?
Yeah.
And then know that in your mind you are going to have to use the debt to still cover. You're not like you still owe money. You still the taxes aren't going away, so you still have to keep that in mind.
Yeah.
But again, like to me, it's better to pay the interest first and then wait till April 30th to pay your tax bill
Yeah.
as
Yeah.
late as
Yeah.
you can, right? Time is money, and interest is accrued daily. So why not take advantage of that yourself?
Yeah. Pay it on the very last day. That's
Yeah.
a smart play. So I mean, and oftentimes when people think of HELOCs, they think home renovations, all those things. Sometimes home renovations, we don't have an option. We gotta redo the plumbing. We gotta reinforce the foundation. Sometimes we're just aiming to look a little bit more like Chip and Joanna Gaines or whoever your favorite flipper is, or a house
Mhm.
updater is. And I think I really like to feature what Cam's doing with this for our overall financial health. Like when you get a HELOC, it doesn't have to be so that you can get the bells and whistles on the house or get the new car. Those kinds of things add, like they got to be updated every 5, 10 years. This is like a long-term play that Cam's kids will be thanking him for, right? Like it's not that you're going to give it all to the kids, but you know what I mean? Like you're setting yourself up for the long run in a healthy financial way.
Trying
But
to, yeah. One other thing I think is important to talk about is, so when you have a line of credit on an investment property, right?
mhm.
That line of credit, when you use those funds, if it's an investment property, you can write off that interest.
Yeah,
Where if it's your primary residence, you can't write off that interest. So if you were going to say buy something that wasn't an asset, so you were going to do renovations on your home, um, to me, if you pull it off your personal home equity line of credit, you can't write off that interest. So if you have, let's say, an investment property in your personal name, right, you could get a line of credit, take off 40,000, 50,000, let's say, pay yourself, right? That interest on that $50,000 that's tied to an investment property then becomes a write-off. So let's say you have your first mortgage interest and then you have your home equity line of interest on that investment property. The cash flow on that property will pay itself. And it's called the Smith maneuver. You may have heard of it, where you're basically understanding that, investment properties in Canada, the interest is tax deductible. On your primary residence, it isn't. And so the reason why when I'm using your line of credit for an investment purposes on the personal property, that's when it becomes a write-off. If you're not using it for investment purposes, like business, something that generates income, then you can't write it off. So if, to me, if you have the option, of course, I know not everyone has investment properties, but if you have that, then, that is something to consider as well, or remember that how the write-offs work.
Yeah, absolutely. Thanks for bringing that up. That's a key thing to keep in mind. Because oftentimes we don't think about what we can, as far as write-offs. My mother-in-law's going by there.
Nice.
As far as write-offs go, it's important to know those little nuances, because you'll be surprised when it comes accounting time when you say, "No, I can write that off," and he says, "Not that."
Oh, yeah, exactly.
Not that boat, even though you took out your friends, your business friends out on it for a fishing trip.
Hmm.
Like buying assets. I think, and I guess I haven't looked much into that as to the whys, but I would imagine the buying and selling of assets, you're stimulating and generating more revenue in the economy and more tax dollars at work, and overall it's a stimulation. But anyway, we don't need to get into the why. My mind immediately goes into that's curious as to the why, but I'm sure it's to do with the stimulation effect. Um, yeah, very
Because
cool.
in the States, you can write off the interest in your primary residence, right? And that's why, like, it's different from Canada and the States, right? And
Yeah,
again,
but not if
sometimes
you take it out to do renovations. Sorry, not if you take it out to consolidate debt, or if you take it out to do something. It has to be
Mhm.
for improving the value of the real estate or buying more real estate. Otherwise, you can't write it off.
We can't write it off. Gotcha. So it's the
Yeah.
same rules.
If
It's
I
kind of like a
consolidate and pay off debt, then I can't write it off. But if I'm improving the property or buying more property, I can. Yeah.
gotcha.
Yeah, interesting stuff. Very cool. So just a high level view, you had a bunch of equity that was sitting there, were able to access it through a home equity line of credit. Super easy to operate. In this case, came up with the Manulife one. Manulife has a great product. Set it up. One of the things too is, you mentioned this in our call, you can break it up into segments, into accounts. So you can say, say you have investments, you can actually subdivide that in your accounts.
Hmm.
I put this in the S&P 500 or whatever. And see, I have this in a real estate investment. Like, you can organize it. Have you used that feature?
No, I haven't, but yeah, it's interesting. You can lock in debt, right? So if you're worried, like one of the fears with doing this, or the risks of doing this, is it's variable debt, right? If the variable rates start going up again, like I wasn't using it when it was up to 6, 7%. It was just hard to capture that spread. Once it gets down, you go, okay, but I'm watching, daily, weekly, if
Yeah.
that rate's going to go back up. But one of the features is you can like take a portion of it. So you could take that 100K that you put in stocks and say, you know what, I can lock that 100K into a fixed amount. They'll amortize it. They'll make it more of like a, fixed rate mortgage for just a portion of the line of credit. Just awesome flexibility that you can have with it. And I mean, the way they can the way they can attach external bank accounts too, like the way you can transfer money between accounts is just so smooth and so easy. Where it's flawless, right? It really is a great product from that standpoint.
Yeah, that's great. Thanks for sharing, man. I think that, like, a significant portion of Canadians' wealth is dormant in their houses. And this is a way to, you have all these, call it workers, call it employees, all these dollars sitting there that could go to work for you and be
Yeah.
paying down your debt or be multiplying your investments. And it's just a great tool to have in your toolbox.
Well,
Uh,
a lot of, boomers, I'll say that, have these paid off homes and they're selling them to access the equity. And I'm like, wait, what? Like, why? Like, that's not the only option. They think that's the only option is to sell their home. And I know people do this where they sell their home, they put their money into the market, right? Their equity that pays them a dividend or interest, and then they use that to pay rent. That is still a great strategy, right? You can still have the equity in your home. In my mind, you can have your cake and eat it too, though, right? Like you can own your home, you can have your equity and put it to use. Is it riskier? Of course, right? Because you're borrowing, you're leveraging higher, you're borrowing more,
yeah.
100%. But it's still backed from the equity of your home, and I'm sure there's a lot of people that could benefit from this product.
Yeah, absolutely. I think one thing to think through too there is when, and maybe this is maybe a side conversation, but when folks are selling and liquidating their real estate, say they're selling their investment properties, they're subject to massive capital gains taxes. I mean,
Yeah.
now, especially with the value increases and the new laws, I think they paused the 67%, but
Yeah.
they're still significantly high in Canada.
Mhm.
Um, and what would your thoughts be? Like, this is a totally different veering into like the folks that are, if we call them boomers or of the age where they've got stuff, they're starting to think about liquidating, simplifying. As a real estate agent, say I have 3 or 4 investment properties in my principal residence. Would you have any kind of advice for which one to let go first? Hold on to them all, like, because obviously, like the Manulife One product, say I have, my home is free and clear and I've got some rental properties that are free and clear, I can't put that product on rental properties. There are some HELOCs that we could put on rental properties, not quite as advantageous. What is there any kind of recommended strategy for paring down when you start to think about paring down?
Yeah, well, the rental properties you're paying capital gains tax on, right? When you sell them, your primary residence is exempt from capital gains. So that's why I understand it's the temptation to sell the primary residence. It's all tax-free money. You have $1 million tax-free that you can sell. Freeing that up makes a lot of sense. To then go forward. Where in investment properties, you're paying the capital gains tax on it. So that's why a lot of people don't sell their investment properties. Just it doesn't make sense to, especially when you can refinance, especially when you can use your home like a bank and pull out capital or refinance. When you're up for renewal, you can pull out money, and it tax free, right? So you can pull
Yeah,
that out tax free when you borrow it. And to me, that's the real benefit when you own the investment properties. When you start to get that loan to value really low, like 20-30%, and you can refinance tax free, makes no sense to sell at that point.
yeah.
So,
This is
so
true. This is true.
but that's where I also am like, people that are, selling their primary residence to take that tax-free money, but then have to go rent or then have to go do something. And I don't want to say it like that. Renting is still great, but there is other options, right? If you need
Yeah,
funds.
yeah,
And I know a lot of people are cash poor right now. They're have tons of equity in their home. And one thing I wanted to mention, I remember I was like, why are people, buying this? You're using this product. And you mentioned the fees. You were like, well, some people are worried about the fees. It's $9.99 a month. $9.99 a month is the fee
yeah.
that I get charged. I don't know if mine's unique or different, or
They
there's
have
any other
raised
hidden
it a
fees that
little
I don't
bit.
know about. Have they
They have
raised it?
raised it a
Okay.
little bit. It's like
What are
15,
the fees of it now?
$16 now. It's like 15 or
15?
$16. Yeah, but you're still, I mean, if you're 15, $16 and you're making $500, like
Oh,
it's
yeah.
cost of doing business, right? But not everybody thinks that way. They think, I don't want to give the bank any more money. And it's like, well, they're giving you access to tax-free money. And that's
Yeah, they're
where
giving you access
that's
to
a big
capital.
one. And I think that's a great point to bring up. It's like, don't be in a rush to liquidate. And I think too, if you're considering, like, just if anyone's watching and you're near considering retiring and you have, a $2 million house or a $1 million house with next to no mortgage on it, like, get one of these before you retire. Because you can't income qualify for it afterwards. So get it
Mm,
set in place and then it's just there. And I
yeah.
think that's an important thing. It's like you don't have to liquidate. You can have access as an emergency fund. If you can help kids with down payments, you can help, the numbers of things you can do. I mean, maybe that's not what people want to do these days, but there's,
You may have to do it though.
yeah, you don't have to sell to get access to that as long as you can qualify for it. So, but thanks for sharing your expertise around it and your personal experience. It's been great to see how you've used it to grow
Yeah,
as
one other use
one of your
case.
tools.
I have one other use case that I think is interesting to share. If
Yeah.
you're selling, if you're like, no, I want to sell, I'm convinced, I'm ready to sell. It's all, I flip homes, and to me, it's always crazy when I see someone cashing out their largest asset,
Mhm.
not flip their own home or
Yeah.
not renovate their own home. They're like, just sell it for whatever. So I'm like, wait, this is your biggest this is your biggest cash out. Once you're done, you're done. Like,
Yeah.
why wouldn't you go get a home equity line of credit, 20, 30, 40K? The bank will literally hand it to you. The brokers will have no problem. They're like, yeah, you have no mortgage. You can get 30K on your $1 million home,
Yeah.
no problem, right? And then renovate your own home, sell it, and then you can close and pay off that line of credit once you sell, and you could increase the value of your home, exponentially, right? So, to me, even if you're not wanting to use it long term, it's a great short term product to make sure you're maximizing your sale when you cash out. It's astounding to me the people that wait and sell their home as is and don't fix things and don't have it looking as good as it can be, especially when they have the equity available.
Yeah, I think that would come down to a couple of things, mindset and convenience, right? But I think it's like this is kind of tacking on something additional, but what would be some recommendations you'd make, like some simple things? Sorry, man, my family chat is like going off here.
No, I
Uh,
can't hear it. Yeah.
somebody needs to, okay, cool.
Hmm.
The like what would be some simple things if I'm going to do that, if I'm going to take some equity out of the house and I'm going to put it in, where would you say the money's best spent? I mean, obviously, if there's some structural things that need to be taken care of that are obvious, they should be taken care of. But if you
Well,
just want
that's
your biggest bang for your buck, what would be some of your recommendations?
Well, the first thing you have to do is go, is there anything damaged or broken in your house? Is there anything that is even wear and tear, right? Like if you're
Yeah,
going, okay, wow, this is really old to the point of like it looks old, right? So old flooring that's
yeah,
ripping or stained, kitchens that have holes in the sink or countertops or chips or any damage in your home. Buyers look at that like, oh, that is something that has to be done. They're valuing it a lot higher. So that's the first thing that you want to look at is what is damaged in my home. Even things like roofs, windows. Nobody wants to buy a damaged home. It gives a bad perception that you don't take care of your home, that you're selling something that is broken. What else could have issues with it? Can't sell anything with a damage to it. And then second, you're starting to then look at um, kitchens, bathrooms, flooring, paint are your standard recommendations. Things like basements, I tell people don't touch. If it's an unfinished basement, a lot of people don't mind that. A lot of people don't care if it's an unfinished basement. Don't worry about adding that. You're not going to see your value on the basement. Kitchens, bathroom, flooring, paint, those four are the major obvious ones, but only if they're damaged, only if they're like, you know, really to a point that it's going to affect a buyer's decision. A lot of people don't mind if it's clean, simple, not damaged. They want to do it themselves, right? They want to put
yeah,
their own flair on it. So if you have a kitchen that is a little dated, from the 90s, from the early 2000s, but it's in really good condition, you may not be worth doing a 30, $40,000 kitchen, right?
yeah,
And you may not see the money from that and worth the stress to your point, worth the,
yeah,
going through all those things. And the other thing you want to think about is, why, people say, why kitchens and bathrooms? When a person moves into a home, they're using the kitchen and bathroom on day one. So
mhm,
anything where the buyer moves in, where they need to cook a meal that night and go to the bathroom and have a shower, they're
yeah,
going to want that done for them. Or they're really going to devalue the home. They're really going to put a negative view or value on the home, and look at it as a major inconvenience to the buyer who is already strapped for cash,
mhm,
right? The
yeah,
sellers have all this equity, have all this money. Why wouldn't they do this kind of thing where the buyers are scraping up down payments? They're borrowing from mom and dad. They don't have
yeah,
an extra money to pay for it. They would rather, get a little bit higher mortgage, get a 750 mortgage instead of 720, and wrap all that into there. But that 30K would be a big chunk of change for them to renovate a kitchen or do a new bathroom. Things that like bedrooms, basements that aren't necessary on day one. Even outside work, backyard work, front of the house, curb appeal is great.
mhm.
That matters, but it's not a functional use that is needed for a buyer. So yeah, those are a few kind of thoughts on that.
Yeah, thanks, man. That's awesome. I think too, I would want to bring up I have clients who are handy and they say, oh, I'm going to take this money out and I'm going to do it myself. And then I have clients that are less handy or possibly handy, but very busy that
Hmm.
decide to outsource the work. And the speed at which the two move are incredibly different. And I think that's one thing I should bring up here is hiring people that do this every day will have done in weeks what will delay your sale 6 months. And a delay in a sale I mean, you're
Oh,
flirting with the market, like
I know
it's
we both know clients that have been through this that were they're mutual clients and that are investors and that I know have financed through you who missed the market peaks and who, I have one investor who literally took 3 years to add in a legal basement apartment. I went, holy smokes, dude, like you saved money, but did you really?
yeah,
Like,
because you do it yourself, and
uh,
and we've all been tempted to do it, and we've all been there. But
yeah.
when I hire, I remember I forget who I hired here, and I imagine my insulation. I
Mm,
had to do my insulation, and I started doing it in one section of the house, like taking it out myself. And
mm.
at the pace, it was fun to do it with one of my sons, but the pace that we were moving at, I was like, this is going to take us like on the weekend warriors. This is going to take me 3 months. And I hired guys that did it in one day, and I
Yeah.
was like that's literally what it would have been, myself versus hiring. So just an encouragement. You don't have to take it all on yourself. And then also you can reach out to guys like Cam or myself who have reliable networking contacts that we've made with reliable contractors. Because you don't just want to hire your brother's, your brother's cousin's friend. Like it's like you want to hire people that are reputable, and you get what you pay for. So anyway, that's a whole nother segue. But I love that concept, bringing it back to the simplicity of Cam's amazed that people don't flip their own home. They'll look for 100 opportunities, but when it comes to selling your own house, and that perspective on when you have the equity and you fix up the house, you raise the market value because now the buyer that was coming in that didn't have the money to do the improvements you did is going to pay more than what you
Yep.
put in and raise the market value of the neighborhood because you raised the value and you're making more money. So it's like
Yep.
everybody wins. They get the kitchen they wanted, or they get a nice start in a freshly painted house with everything repaired. And
Well, yeah, I was gonna say to your point, like of reaching out to people, professionals that are in the industry like yourself and me. We have contacts that are can get the work done for you, but we know when you're getting ripped off. We know when, what price you should be paying for things. And what I've found is most people are surprised now at what you can get done as far as kitchens and tiling and bathroom and painting and flooring. There is very cost-effective ways to spruce up your home. And like you said, not do it yourself, not have the stress of that and the time that it takes, but still, maximize the return of the sale. And yeah.
yeah, absolutely. Well, some good conversation as always, Cam. Thanks for
Oh, a
taking.
lot of fun.
And yeah, thanks everybody for tuning in this far. And if you have any questions, feel free to reach out to either of us on Instagram. Cam, where can folks get a hold of you?
Yeah, I'm on Instagram, Cam Cassidy Real Estate, my YouTube channel, Cam Cassidy Real Estate as well. That's where I'm hopefully posting this video as well. But yeah, Instagram, I'm on Twitter or X as well too at Cam Cassidy. You should be able to find me. Should be able to search
Awesome.
and reach out to me.
All right. Thanks, Cam. You're a wealth of
Thank
knowledge.
you.
Appreciate you. Take care.